Discussion. Ravi Uppal, Chairman, Syscall and former Managing Director and Group CEO, JSPL, as well as Peter McGuire, Chief Executive Officer at XM Australia, now join in to talk a little bit more about the situation as a whole. Thank you so much, gentlemen, for taking time out. To begin with then, Mr. Uppal, I'm going to come to you first. We're once again staring at a situation where the global iron ore prices seem to be pushed on multi-year highs. We're seeing steel prices, which is facing a downward risk. When you were at JSPL, you too had to tackle with a similar situation. So, you know, having been in that spot, tell us how you think now steel companies can deal with this.
Manju, the calendar year 2018 has been very good for the steel industry. It helped them to recover their fortunes from the bad times of 2015 to 17. And actually the prices went up by nearly 40% between October 2017 to December 2017. This was partly because of the reason that the input material cost had gone up. Iron ore prices had gone up by nearly 120% from what it was in October 2017 to December 2018. So part of the increase in price was caused by due to the price of the iron ore. But I think on the whole, the 2018 year has been very good for the Indian steel industry. The demand went up by nearly 6% and the production has gone up by nearly 7.5%. And I think, going into 2019, the first quarter looks quite good. But I think beyond that, there's a certain amount of uncertainty which continues because of the impending elections. So, the new orders, will depend as to what the outcome of election is. But I reckon that from April till about August, the demand is will soften a little bit, and especially from the infrastructure sector, which accounts for nearly 68% of the total demand that we have in India. And the rest of it, of course, comes from railways, automotive and capital goods. So I think that generally the demand for steel should be good, but 2019-20, I'll keep my fingers crossed. It will depend as to how soon the new government gets into action post-election.
Right. Peter, I want to get you in on the discussion as well. After a week-long holiday, China has woken up to iron ore prices at $95. Now, that's a multi-year high and a significant surge just in the last week. All attributable, you think, to the newly emerged supply shortfall fears?
Well, good morning. I think a couple of things. First off, you've had that a very, very strong rally in both iron ore and crude since Christmas. They were both heavily sold off, and now you've seen them rally very, very strongly. As my other guests are saying, you've seen that huge move in 17 and what you experienced in 18. November lows in 2018, the market was hammered to the downside. Up since then, it's the best part of about 45 to 50% move to the upside. So that's in that 3-month window. Over the last month, it's been very, very strong, and now you've got the Vale situation, and of course, what China's going to do, re-stimulating with infrastructure spends. I think you're probably heading higher from here. I wouldn't be surprised to take triple digits out sometime in February or early March, and you've got the issues as far as the Brexit and China-US trade talks and President Trump. So there's a degree of uncertainty globally, economically, but I think China's going to push it higher, and it's going to be a great time, I think, for miners in the short to medium term.
Okay. Mr. Uppal, what exactly is your assessment as to what extent the overall global situations, the current one being the sharp cut as well that we've seen in the iron ore output from Vale, could cushion steel prices?
Well, if you look at the calendar year 2018, the global demand grew by 3.9%, which was unprecedented. I mean, just a year before, the total demand grew only by 1.3%. And therefore, the year has been very good. And I would say going forward, the tempo demand will remain pretty good. India's own demand is likely to stay at around 6 to 7%. And the case of China, of course, is always a bit of a question mark.
Getting a snappy line there. Peter, just want to get your thoughts in. To what extent do you see a cost push factor for steel coming in?
Well, I think you've also got to take on board the Tangshan issue as far as China's largest steelmaking city. There's talks that they'll be shutting half of their production from the best part of April to August for air quality, and we understand, as far as pollution and air quality across China and India, of course, are major concerns. So that's going to be, I think, add more opportunity for further price hikes. And the Vale situation, whilst it was, you can't deny it's a tragedy, a human tragedy. I'm not sure how that's going to play also. So I think that, the overall, as I mentioned, it's going to be an uptick from here for mining. It's going to be an uptick for ore prices. What's fascinating, I didn't see a lot of movement really. It's been range bound, the copper market. But iron ore and crude have had nice rallies over that last, 6 or 7 weeks. So I think that that's going to remain. Stimulus coming into China for infrastructure. And, you can't take your mind away as far as global demand, from motor cars to highways to all forms of building and transportation. You've only got to look at your own city, Mumbai, and the transits that's going on there as far as the underground railways and so on. That phenomenon is going across the world. So, the needs and wants as far as steel is just, incredible. So, and that's not stopping. So I think it's going to be, I think, a very, very strong 2020, 2019 and 2020 for the mining industry and for ore.
Peter, but we're in the midst of an environment that's spooked by the slowdown in sentiment. EU, IMF have both cut their growth forecasts. This could also put pressure on steel prices, while iron ore prices are at a multi-year high. Would you say this is worrisome time for steel companies in particular?
Well, it could be worrying in some capacity, and there's no doubting that, the Eurozone in 2018 was weak. 2019, I think, is going to be bleaker. It's not going to be an uptick from there. It's actually going to contract further. What happens as far as these China-US trade talks and what impact that's going to have is an unknown. No one really can get their mind around it, let alone the two presidents that are trying to, put together a deal in some capacity or form. And yes, there are markets that go to, contract, but there are other growing markets, and you can't take your mind away from, overall consumption going up with the amount of population-based explosion globally. More inhabitants in the world and more buildings and more construction, and the needs for every part and parcel, from washing machines to, to cooking utensils, you name it, everything's got steel in it. And I just think that it's going to, continue to move forward from here.
Right about that, Peter. But, Mr. Uppal, to get you right back into the discussion, do you think that the Indian steel industry is being once again threatened by the risk of the higher imports, as the recent data shows the FTA countries are diverting steel to India due to the US-China trade war? How worried should you be?
Well, the imports in India are just a fraction of our total demand. Our total annual consumption is close to 100 million tons. And we are importing at a rate of about 7 to 8 million tons. So I don't think that is such a major threat. And the second thing is that we still have the anti-dumping duty in place. So that also acts as a deterrent against any kind of rampant imports into the India. I think the Indian market right now has, is very focused on domestic consumption, which is rising at a rate of 6%. And the capacity utilization has improved dramatically. And as you know, that there has been some amount of consolidation in the industry. Today we have 6 producers who are holding about, the 70% of total capacity in India. So I think Indian industry will do well on the whole. As far as iron ore prices are concerned, my sense is that the prices will not increase without limit. It might in the short run increase because right now the demand is pretty robust. And the total usable iron ore production in India is only about 150 million tons. Although the gross production is about 220 million tons, but usable is only 150. And 30% of Indian steel is produced from scrap. And mind you that in the long run, that the scrap is going to get a bigger share in the total steel production. Also for the reason that it is used through the arc furnaces, which are more environment friendly, which is precisely what China is doing. So I don't think in the long run the iron ore price is going to increase. They're increasing at the moment because the total production of crude steel has gone up very fast and the production of usable iron ore has not grown proportionally. So long run iron ore prices will soften. They will not stay at the levels which they are. They are happening at the moment because the demand for iron ore has increased, unexpectedly in the last 8 to 12 months' time.
Okay, so while global steel companies are struggling, Mr. Uppal, with compressing spread, India's high growth and steel demand outlook keep the spreads relatively stronger. Would you say that in that sense we're at an advantage that way?
Well, the Indian iron ore prices are substantially less compared to the global prices. We can always talk in terms of $80 and $90, but in India, the iron ore 65 grade is getting sold at about 3,500 rupees per ton, which is about $50. So the Indian companies, they have one major advantage, which is the lower price of iron ore compared to the global prices. And that is what makes them more competitive.
All right, gentlemen, it's been a pleasure having you on board, giving us a sense of how things are shaping up within the industry, the lingering trade war anxiety, as well as the iron ore prices. That was Mr. Ravi Uppal and Peter McGuire giving us their expert opinion.